Our next presenter is the Managing Director of De Grey Mining, Glenn Jardine. De Grey has started diggers with an outstanding announcement this morning where they intersected 359 metres at 1.2 grams per tonne of gold, 200 metres below their current resource. And this has left their resource still open at depth. Just a bit of background on Glenn. Glenn is a senior mining executive with direct experience growing resource companies from early stage exploration all the way through to multi-operation entities, which includes taking projects through feasibility studies, equity funding, debt financing and project development. Projects he has helped develop have received Australian, state and federal recognition for environmental best practice in health and safety and human resources systems. Glenn is an avid sports fan. As a Queenslander, he loves the rugby league and also supports Collingwood. Any joke about Collingwood is low-hanging fruit, so I'm just going to leave it there and pass it straight over to Glenn.
Wow, I didn't know that was coming. Thank you very much. It's a real pleasure to be able to present the De Grey and Melina Gold Project story to you today in person. On behalf of the company, our employees, contractors and consultants who've added so much value to the company over the last 12 months since last we spoke. Since then, we've put out an upgraded mineral resource estimate. We've done a stack of drilling into that resource to lead into the PFS that we'll announce this quarter. And as we go through this presentation, I'll talk to that announcement that we made this morning, just under 360 metres at 1.2 grams per tonne gold underneath Ducon. For those of you who are watching online, just be aware that we put out this presentation earlier today, but due to time constraints, this will be a cut-down version of that. And I'll just proceed now. Okay, so that's our disclaimer regarding forward-looking statements. Please take note of that. I'd also like to acknowledge the traditional custodians of the land on which we work up in the Pilbara, and particularly the Gariyara people, who are the traditional custodians of the land over the Hemi project. Quickly onto the board of directors. We've got a really experienced board, and that's been evolving over the last 12 months since we discovered Hemi and have moved into project development phase. This year we brought on Samantha Hogg and Paul Harvey as independent directors, and both of them have resources experience, and particularly around project development and operations. So we're really pleased with the way the board's evolving. Also, in terms of the management team, over the last 12 to 18 months, we've been building up the technical and other capabilities within that management team, and also people who are reporting into that team. And the reason for that is because the maximum shareholder value that we see for De Grey Mining is for De Grey to bring Hemi into production, and we want to make sure that we've got the capability to do that. Just in terms of share price and corporate overview, we're sitting at around 90 cents, which is a market cap of around 1.3 billion. And at the end of the June quarter, we had around $64 million in cash. Our current burn rate's going to be trending towards $5 to $6 million per month. Now, one of the themes of today's presentation is around value, and what I want to speak to today is the catalysts that we have for value re-rating in the stock between now and eventually when we get into production at Hemi. So in terms of where we are, for those of you who may not be familiar with the project, we're about an hour's drive south of Port Hedland, and that's our tenement package there, to scale relative to Port Hedland. Unlike some recent large-scale gold developments in Australia, we're absolutely blessed with world-class infrastructure. So we've got the Great Northern Highway just 10 kilometres to the east of us, the Coastal Highway about 20k to the north, and then there's power lines as well as gas pipelines in the vicinity. Port Hedland's an export port, as you know, but it's also an import port, and we see that as being really valuable for bringing in equipment and consumables to construct and operate the project. In addition, in terms of our decarbonisation plans, there are plans in place and also facilities in existence already in terms of renewable energy supplies. and we're looking at how those renewable energy supplies can fit into the decarbonisation plan for Hemi, along with technical advances in mobile equipment fleets. So when we put out our pre-feasibility study this quarter, we'll have a decarbonisation plan in that, and we're really excited about that because that looks like we'll be at the very low end of carbon intensity per annual ounce of gold production. And just closing in a little bit on that tenement package shown here in gold, we released a 10.6 million ounce resource in May, and all of that increase from the maiden mineral resource estimate of 6.9 million ounces was at Hemi, so a 25% increase in the resource there. We also have regional deposits. Withnell Mining Centre has 1.6 million ounces at around 2 grams per tonne, and Wingina 500,000 ounces at 1.4 grams per tonne. Hemi's 8.5 million ounces is at 1.2 grams. Those regional deposits in the scoping study that we put out in October last year contributed about 1 million ounces to the scoping study production target, and they'll contribute significantly again to the pre-feasibility study. Okay, so just in terms of Hemi, it is a rare and really valuable Tier 1 gold project. A couple of things to point out on that slide, not necessarily all of them, but one of the things to bear in mind is that the maiden mineral resource at Hemi grew at just under 500,000 ounces per month since the discovery, RC discovery holes in February, March 2020, and when we put the maiden mineral resource out in June 2021. Since that time, a lot of the drilling that we've been doing has been focused on getting that resource, the maiden resource, into indicated classification leading into the pre-feasibility study this quarter, and that's so that we can come out with our updated production rate and that people have a lot of confidence in that production rate when we put it out. You'll note that in terms of that scoping study, we had 430,000 ounces of production over 10 years at a lowest quartile production cost and an NPV of around $2 billion relative to our current market cap of 1.3. The payback on the project was less than 2 years, and I'll explain in a little while why that's the case. So in terms of value catalysts, one of the things we have in our strategic plan is to keep on drilling, and that the result this morning, and I'll show you some cross-sections of it later on, is one of the reasons that we're keeping on drilling, because we see value accretion coming from exploration success. The pre-feasibility, we're targeting an upgraded production profile compared to the scoping study at a higher level of indicated classification and over a longer mine life. So that's another catalyst. And then we'll be moving into a funding process while we conduct a DFS ahead of construction in late 2023, and then into production with an ultimate re-rating when we're in production at what we hope will be around 500,000 ounces a year in late 2025. So just in terms of scale, with the resource at Hemi, on an Australian basis, it's sitting in the top 5 at 10.6 million ounces. Just to have a look at some deposits that you'd be familiar with, some high-quality deposits in Gruyere and Tropicana. One of the things that's clear from those two deposits is that when you find a high-quality deposit, they just keep growing. Hemi's currently 2 years old. After 5 years, Gruyere and Tropicana pretty much doubled their resource base. What will Hemi be in 5 years' time? We don't know, but the Hemi resource at the moment is only 2 years old, and it's sitting at 10.6 million ounces. Something to bear in mind around the Hemi resource at 8.5 million ounces is 8 million ounces of that is sitting above around 370 metres, which is a nominal depth cutoff that we use for open pittable resources. It's showing there only 400,000 ounces below that level. That's simply a result of lack of drilling. As I said, in the last 12 months, we've really been focused on doing a lot of resource definition drilling for the pre-feasibility study. We're now able to get out of that and take a bigger picture look and look at large step-out resource extension drilling, and also more exploration drilling, looking for large near-surface intrusion deposits. You don't get 8 million ounces near surface and only sit there at that point with 400,000 ounces underneath that. We've heard about some strike metrics from different projects this week, and when you look at all of the deposits at Hemi that make up that 8.5 million ounces, if you put them together, they've got a combined strike of about 6 kilometres. And again, it's a situation where it doesn't take much arithmetic in terms of success rate to see how much gold could be sitting underneath that. For those of you who are from Sydney, going east-west there of around 3.5k gets you from Circular Quay to almost Redfern Oval, and then the north-south component swallows up the CBD out to the Domain in Sydney. Okay, and this is what we're talking about in terms of resource upside. So this is the announcement we put out this morning. The dashed line that you can see there is the mineral resource outline from May. The pit you can see there is a pit shell optimisation, and we reported some resources within pit shells in the maiden MRE, so that's what that's looking like. And that intersection sitting there is approximately 200 metres beneath the May mineral resource estimate, and it's also probably about 300 metres below that open pit shell optimisation that we announced in the MRE. So the significance of all of this is that there's clearly resource growth upside at Hemi, and it's demonstrable. In addition, that sort of intersection with a bit more drilling may result in an increased scale of pit shell optimisation there. And also some of the grades there point to the potential for either really large-scale underground or more selective underground mining. So there's 19.3 metres sitting in there at 7 grams per tonne, and the deepest intersection there is around 16 metres at 2.8, and that's about 700 metres below surface. So these are really large-scale deposits, and as we mentioned before, once you latch onto one of these things, the resource growth potential is sitting at around about 500,000 ounces a month. And again, those of you who've got your calculators there, can have a look at the May mineral resource estimate for Ducon of 1.6 million ounces and see that run rate's probably been exceeded in the 2 months since we put that out just by this one drill hole. The other thing that's interesting on this section that I'll point out is that intrusion is sitting underneath some relatively low-grade gold anomalism in sediments near surface and intrusion down to around 100 metres. So it's quite amazing that you can get that sort of intersection sitting underneath what for us is relatively slight gold anomalism. And I'll show you later on, but we've got a lot of that floating around Hemi, and we just need to follow up that sort of anomalism and see if we can jag another one of these deeper intrusions. That's another look at the result relative to the resource we put out back in May, and also the pit shell optimisations that we reported in that resource. Unfortunately, this result's come in after we've closed off drilling for that resource estimate, and we used that May resource estimate to come up with the production metrics that we'll announce in the PreFeasibility Study. So clearly, resource upgrades and studies beyond the PFS should result in either increased production rate or longer mine life than we're going to come out with in that study this quarter. Okay, and I just mentioned that we've got a lot of near-surface low-grade anomalism. This is a plan view of Greater Hemi with mineralisation that we've intersected both at Hemi and also around it in Greater Hemi in places like Antwerp, Scooby and Goshawk. There's a lot of smoke around there. We have been focused on getting this May resource out, so we're going to spend a lot more time now looking at all this data and coming up with drilling plans to see if we can find near-surface intrusions like the ones we've got at Hemi, and also deeper discoveries. In terms of deeper discoveries, I talked earlier about the resource above 370 metres. That's the amount of drilling we've got at Hemi at the moment. This is the amount of drilling that sits below 370 metres. So as you can see, it's completely underdone, and that announcement and result that we put out today demonstrates that there's way more to go here. Also, in terms of regional potential, in the June quarter, we came out with some results at Charity Well. We're looking for intrusion-hosted deposits across this entire 150-kilometre tenement package. At Charity Well, we came out with mineralisation around 1 kilometre in strike length. These are the sort of results we were getting. We'll follow up those sorts of results with additional drilling when we get heritage surveys to the east there. But obviously we're getting really good scale, good grades in the regional deposits outside of the Greater Hemi area. So just onto the pre-feasibility study that we're looking at. This is the production profile that we had for the initial 10-year evaluation period in the scoping study. 4.3 million ounces in that scoping study in terms of production. We had to leave quite a bit of inferred mineralisation out of that production profile, and we also didn't include any increases to the scale of Yukon and Eagle that we've subsequently drilled out since this scoping study came out. So we're expecting the pre-feasibility study to come up with a higher annual gold production rate, as well as a longer mine life. Now, one of the really interesting things that we had when we did the infill drilling at Hemi was we didn't see a reduction in grade, and at Yukon and Eagle, we increased the combined grade there of 0.9 in the maiden resource estimate to just over 1.2 grams per tonne in the May estimate. So the impact of that is that we'll get better grade coming through in the production schedule, and that's going to be one of the things that'll increase, that we're looking at in terms of increasing our production profile for the PFS compared to the scoping study. This is the scoping study outcomes. So NPV of just under $2 billion. We looked at a 10 million tonne a year plant size, and we're still looking at that for the PFS. And then the payback period was under 2 years. Now, the reason for that low payback period is to do with the Brolga deposit, and the starter pit at Brolga has around 1.3 million ounces in it at a strip ratio in the scoping study of 2:1. And that's the first pit that we'll go into, the starter pit there, the stage 1 pit, and that's what's behind the rapid payback. And I don't see that changing too much into the PFS. In terms of scoping study production, we're sitting around in the top 5 at that 430,000 ounces per annum. We'd like to see if we can improve on that for the PFS. One of the things we're doing in the pre-feasibility study is we're not just trying to grab ounces for the sake of ounces in terms of our production profile. We want to make sure that they're really profitable ounces, so we're still going to be targeting that lowest quartile cash cost of production. This is our flow sheet for Hemi. We've got a really nice mineralised system there that's very amenable to this flow sheet, particularly around the flotation, oxidation, and then CIL. So we get a really good sulphide recovery and gold recovery into a low mass concentrate from the flotation circuit. That'll go into a POX circuit to deal with the sulphide gold. But we're also blessed because the non-sulphide gold has between 5 and 7% gold recovery sitting in it from the flotation underflow, and that'll go straight to CIL. So a lot of refractory deposits around the world, they're getting 85, maybe 90% gold recovery. Because of that dual recovery through POX and the flotation underflow, our recoveries are sitting in the 93, 94% range, and that's the reason for it. It's all to do with the mineralogy at Hemi and how it's really amenable to that flow sheet and pressure oxidation. We've heard about ESG, and I've spoken a little bit about our decarbonisation plans. We're following the ICMM principles and also the ICMM and also the TCFD principles. And decision-making that we've had to do for the pre-feasibility study has incorporated those principles into those decision-making processes. And when we come out with the PFS, and as everybody knows, it's very important for funding and also in terms of our corporate citizenship, we'll be having some detailed information in there on our ESG processes. As far as a schedule's concerned, as I said, we're looking at getting that pre-feasibility study out this quarter. We'll go straight into a DFS and a funding process off the back of that. And we're looking at making an investment decision in the middle of next year, a 2-year construction period, and then into production in late 2025. As far as the growth strategy is concerned, it's quite clear we want to keep drilling for new discoveries. We want to grow the Hemi and regional resource base. We want to continue to improve the production metrics and at the same time integrate ESG principles. And we see the greatest value for De Grey shareholders for De Grey bringing Hemi into production. Thank you. That's it.
Great, can you put your hands together? We just have time for one question if there's any in the audience. If not, we've got one here. So with the feasibility study due soon, is the impact of inflation a major concern for you versus the costings you used in the scoping study 12 months ago?
Yeah, it's a good question. We're currently working through our capital and operating costs for that pre-feasibility study. In terms of the operating costs, thus far we don't think we're going to see an issue there because we think the annual run rate on gold production will deal with whatever increases there may be in operating costs. In terms of capital costs, again, we're working through those capital costs. They're being estimated at the moment, so I don't have a quantitative answer for you on that. But this project, as you've seen from the payback period, is quite insensitive to capital. You know, with a payback period of under 2 years, this is the lowest capital intensity on an annual gold production basis project in the world. And the project's just relatively insensitive to capital.
Great. Thanks, Glenn.
Thank you.